Hello and welcome from the JW Marriott Hotel here in Hong Kong. You're watching the live web stream from SuperReturn Asia 2016 with me, Natalie MacDonald. Over the next 15 minutes, we'll be discussing some of the trends, topics, scandal and gossip even perhaps, emerging from day 2 of the SuperReturn Asia conference. And I have my fantastic panel here with me this evening to help me out with that. So without further ado, I will introduce them. And to my right, I have Kaz Kobayashi, my apologies, for the Managing Director of Capital Dynamics. Kaz, thank you so much for taking the time to chat with us today. Really appreciate you being here. I also have Paddy Sinha, Managing Partner of Tata Opportunities Fund. Paddy, thank you so much again. And on the end, last but by no means least, certainly, I've got Rob Petty, who is Managing Partner and co-founder of Clearwater Capital Partners. Rob, thank you so much again for joining us.
Thank you for having me.
So, gentlemen, I'd like to raise a toast, a cheers to day 2 of the conference. Thank you so much, and to a successful chat today. Thank you. Cheers.
Cheers.
Okay, so let's hop straight in. And one of the first things I really wanted to discuss, and something that's been coming up a lot over the last 2 days, is really environment and understanding your environment and perhaps positioning oneself in a more opportunistic way, perhaps. Now, obviously, over the last year or so, there's been a lot of discussions regarding, the health of China's economy, volatility amongst its market region. What are some of the implications that you gentlemen are noticing within the industry, and also some of the conversation that's popped up over the last day or so? The impact of that volatility on Asia private equity. Rob, perhaps I could ask you to start.
So volatility is a reality of Asia, and I think all of us that have been practitioners, actually one of the first things you see is just look at any chart and volatility is constant. We've actually seen a lot of it this year, whether it's Chinese RMB currency volatility, whether it's stock market volatility, or it's just sort of even the credit markets where we operate, a lot of volatility. So I think all of us who are seasoned managers, you heard that coming out on the panels today, people are operating and thinking contrarian. How do you think about entry points? How do you think about exit points? So I do think people are thoughtful about all the volatility. One person on the China panel talked about, stable, steady Chinese growth, even if it's slowing. Underneath it goes like this. And I think seasoned managers operate that way, and I think that really came out across panels, that you need to be thinking about your niche and taking advantage of volatility rather than being trapped by it.
I think there's that image almost of fund managers, gliding effortlessly across the top of the water like an elegant swan or duckling, and underneath paddling like crazy to try and keep those margins high and to keep that sort of run going. I'm unsure if it was in your panel today, but the discussion, perhaps in another panel, it was talking about being an optimist, but a somewhat skeptical optimist. And again, we heard a lot today about operational approach and really considering that within sort of your operations. Again, is that sort of the way to go forward and attempt to somewhat negate some of that volatility?
Again, certainly speaking for ourselves, but again, all the peers of sort of the top tier GPs that were speaking on panels today, I think of it as we're in our second generation of sophisticated developed managers, and everybody has to prove their niche and their excellence. And operations is clearly the theme that I think was brought out by many of the traditional PE guys. Whatever strategy you're doing, you need to be niche and specialized and really have, in this case, operational skill sets to execute that. But I do think whether it's credit or whether it's PE or whether it's venture, we heard different elements of real excellence in executing your component of a strategy as people get more and more sophisticated in their specific strategy. You got to be different, I think you were saying, Patty. You got to really, excellence in your niche, and operations is a key component of that.
And there was a discussion also in terms of, Patty, doing fewer but more consistent deals. There was a discussion regarding funds and also within private equity, and it's making sure that they are niche deals, that they are value add opportunities. And Patty, I come to you. How are you considering that volatility and how that's kind of shaping PE also?
So as far as the China bit goes, I could split that into 2 bits. The first is the impact on investment flows, and the second is the impact on business operations of underlying portfolio companies. So if you take investment flows, as I mentioned in the morning panel as well, for Indian private equity, to pick an example, we've seen the investment flows both in terms of investments in India by private equity investors, as well as LP investments in country-specific funds. They've been quite stable and at sustainable levels. So I don't see any consequence to it. There could be consequences on public markets of Chinese volatility, but private equity is a longer-term business, and I don't see any immediate impact of volatility there. In terms of your other point on trying to build a portfolio with more consistent returns, I think, for example, we try and do that. So we're backing higher quality companies. Robert correctly said, higher beta is typical of Asia as it is. You don't want to compound that further by investing into high risk, high return portfolio companies. So we try and back market leaders, top-notch management teams, and then bring in our case, the value add by virtue of our association to the Tata Group, and operating value add, of course, is an important theme. But I think the key differentiator that came out, at least in a couple of the panels I saw, was you need to position yourself as a PE fund with a differentiated strategy. The time for sort of me too vanilla funds in a competitive world is perhaps gone.
Kaz, so I'll ask you. I mean, and you spoke on Japan today, and
Yes.
whether now is the time for Japan. I mean, again, how much do you consider some of the China economic volatility that we're seeing within whether or not now is the time for Japan?
Yeah, looking at the private equity investment, that is not much affected. Anyway, there are so plenty of good companies in Japan, and they are doing very good business in China or globally. And then also some China slowdown affected a little bit, but still they have a good business, good technology, good products. So I think the GP is very good at finding good company and invest, and so we can have good return.
Now, one of the other items also in terms of having that follow-through effect and perhaps impacting the market, we're also discussing the implications of both direct investments and also co-investments, and their impact kind of on the industry also. And in fact, as we speak, there's another panel session going on about what happens when co-investment goes wrong. So we can sort of only assume in that respect. But again, gentlemen, what are you guys seeing in terms of the implications of both direct investment and co-investment?
I sort of think about it first, capital flows. I think it is representative when large pools of capital themselves, are allocating to Asia. So we have teams of direct investors from some of the largest sovereign wealth funds and capital providers here really doing direct deals. And arguably, I think that's a good thing, right? It is representative of where capital is allocating to Asia, and people are making permanent, decisions to allocate capital here. So from a, capital into the region, it's a positive thing. From a competitive environment, I think some of the bigger buyout firms are finding them competitive, pools of capital for deals they're doing. But broadly speaking, for most of us, I think it's good partners to enhance what we can do. So speaking as mid-market players, which I think most of the universe really falls into, this enables everybody to have more firepower. Right? So the big co-investment capital, whether they're co-investors from our core LP base or direct investors themselves, most people give themselves more firepower to do good deals. So I think it's a differentiator if you really have co-investment partners and the ability to do that, but it is representative of sort of the overall capital flow. So you got to be more competitive, you got to play against them, or conversely sort of play with them. That's how we're seeing it fall out in the deal basis.
Are you seeing a higher level of sort of deal due diligence then because of that sort of competition element?
No, I would actually say diligence is still led by the guys doing the deals. So obviously people doing world-class diligence. I think you see the caliber of diligence has changed in the past decade. So, but I think best-of-class diligence is here. So I think that's a done reality of Asia and has been for a good while now. So that you already see. I actually would say the reliance on the lead GP in a consortium with co-investors, has actually gotten that much higher because you have people looking over your shoulder.
But Patty, what's the real kind of incentive that we're looking at for co-investment? What really drives that?
No, I agree. It gives you more firepower. So if from the fund you're looking at $100 million deals, you can address potentially $300-400 million deals through co-investments with some of the large LPs. And it is collaborative, I think, particularly with country-specific funds or mid-market regional funds. It's a collaborative approach because I think big LPs sitting out of North America, for example, would clearly see value in partnering with a GP, and they don't really want to go on and do a deal on their own usually. It also creates a better sort of information and feedback loop between LPs and GPs, because we find it useful even in some instances where we know an LP is unlikely to co-invest. If you know the LP has some knowledge of the geography or ecosystem, to have a discussion, because there could be some rich perspectives coming out of that. So that's another benefit. But I think generally for country-specific or mid-market funds, it's a positive development.
So I know you, prior to this discussion, we were talking about, what happens when co-investment goes wrong, and you said, it doesn't, you're unlikely to see it happening very often.
I hope so, and I was just wondering, I don't know, I assume it will not be an easy situation, because even if a portfolio company is not doing well and an LP has an exposure through a fund, it's always, it's good to communicate, bring them on board, but if they themselves have a direct exposure, I guess the positive of it is that communication is much easier, because you'll probably be getting information at the same time, but there'll be more dollars at work, so I don't know. I don't have an answer to that, fortunately.
Well, co-investment is just kind of one of the tools, as you said, it gives you a little bit more firepower. But Kaz, I wanted to come to you and ask you, how are managers generating decent returns in Japan?
Firstly, in Japan, still it's pretty mature market, very inefficient market. So basically, say compared to US, European market, GP can buy company cheaply. That's one thing. And the second thing is, say, value creation, so operational improvement. So then they are investing, say, SMEs in Japan. There are lots of room to improve the operation profitability. So they can, say, improve that profitability. So those two are, say key of, say, good return.
I was just going to say this valuation point is something that I did hear talked about across various panels today, and did hear in sort of the sidebar coffee sections, that actually Asia today in some markets really is actually relative value. And so as people are looking at opportunities, the valuation, while everybody's nervous, they're particularly nervous in their portfolios in the Western world. And so as they're thinking about, ultimately valuation is the single biggest driver of return in terms of entry price, right, that they're actually finding good relative value. And I certainly know it's true in the credit space, right? Absolute yields in the credit space are drawing in Western capital. But I've also heard it's very true in the PE space, that the relatively attractive valuations in Asia fundamentally are getting people excited about things. In a sort of calm excitement, this is interesting on a fundamental basis. Valuations are attractive in Asia relative to the rest of the world. And that hasn't always been the case in Asia. And I do think that's something else that I heard coming out during the conference today.
Absolutely. I think it was some comments made yesterday also, in fact, that valuations still remain on the positive side.
Yeah.
Now, markets are expensive, and I think this was commented on in your panel today. Markets have always been expensive and are becoming more so when you have sort of a lot of capital flooding coming into play also, but the valuations still remain on the optimistic side. So if there's still value in the markets, and that means you gentlemen still have some work to be doing. But one of the things, just as a final note, is I did find on a conference side, people seem to be a little bit more raring to go. Now, for those of you who was watching post-election, this morning we did have the first US election presidential debate. I know a lot of the participants were tuning into that prior to the panel. In fact, at the beginning of your panel, we got some of the reaction tweets coming through, which was very entertaining. Obviously, this is globally on a political front, highly important. But is it something that you guys see as a risk to your business moving forward as well? Kaz, you mentioned previously it's not a huge concern for you.
Yeah, because private equity, we are long-term investor, and a lot of things happened in the last, say, 20, 30 years. Asian crisis in Asia, say US elections, say wars. So then we have to live with that.
And for you gentlemen also, and Rob, again, you'd mentioned earlier that it is in terms of the market shape, as it is a risk moving forward.
Kobayashi-san's right that we in Asia have lived through a lot. The Asian financial crisis, the global financial crisis, SARS, you name it. We've dealt with a whole lot and have sort of remained standing as an industry, and that's generally creates opportunities. This one is one that worries me. I'll be very honest. Two core reasons, right? terms of trade, free trade and freedom security. So the freedom of the seas and the free trade have anchored much of the growth of Asia. And while I don't doubt that that can be the case, I'll be very honest, if we have Mr. Trump, I think the Asian investment world gets worried.
It is a concern, I think it is, but it will certainly provide plenty more discussion opportunity kind of coming up over the next few weeks also leading into that election, and naturally post afterwards. And again, those people at home who can watch back and sit here and laugh because they'll probably know the outcome by that. But gentlemen, I will take this opportunity to thank you very much for your time. Are there other items perhaps over the next day of the conference that you're even looking to hear or wanting to hear a little bit more conversation about? No, it's all been good so far. Rob, Betty, Patty, Kaz, thank you so much for taking the time to chat with us today. We certainly appreciate it. And that does bring this live stream from SuperReturn Asia 2016 to an end. I'm Natalie MacDonald. You can continue to watch all of the action. Just use the hashtag SRAsia. I will be back again tomorrow for the final roundup of the conference, live broadcasting here from the JW Marriott Hotel in Hong Kong. Goodbye for now.